the single greatest problem in the industry, and where there's obviously a huge amount of venture capital and private equity going into points of disruption, is around payments. And if you think about how antiquated the payment rails are in the U.S., if you look at if you go outside the U.S. and you transact with QR codes at merchants, where effectively there's a ledger on the back end moving money into their account, versus interchange, where it's super expensive, it's got chargeback issues, it's got settlement issues. There's a lot of room for us to improve the payment rails in the U.S. And this is happening on many different dimensions. So obviously a lot of us are looking at blockchain solutions as a way to do this. There's white papers out there from the Fed in terms of their central bank digital currency replicating what the Chinese have done. But at the end of the day, there's a pretty significant opportunity, and the opportunity is really manifested in what the Visa and MasterCard market cap is, which is over $1 trillion. So you can think about solving payments as solving $1 trillion problem, or creating or moving $1 trillion from those incumbent payment rails to new payment rails. I think more recently, we've certainly seen the problem on the exchange side with T+2 settlement, the whole GameStop fiasco, where Robinhood had to put up an enormous amount of capital in relatively short order. The reality is, on any given day, the large sell side brokerage firms have $500 million to $1 billion of equity capital sitting with DTCC against settlement risk, and it's a huge amount of money, and it's purely an artifact of T+2. And so, again, blockchain technology, because it's real time, it's bilateral, has the opportunity to massively disrupt the exchange ecosystem, get us to T instant in a way that has all the benefits of netting and leverage that the current system has, but eliminates the settlement risk. And so, I think you're going to see more go into the exchanges, although certainly, some of the exchanges, especially outside the US, have garnered pretty significant market value. And then I think, as it relates to lending, it's really a combination of better tech, but also it's really the GSEs, Fannie Mae, Freddie Mac, that need to step in and introduce better technology for loan delivery. So right now, it takes 14 to 21 days to get your collateral to one of the agencies, one of the GSEs, and it's a completely antiquated process using Deutsche Bank as a collateral agent. It introduces a lot of cost inefficiency and equity capital into the ecosystem, and that's a huge opportunity for disruption, and one that think of the top three custodial banks. They have $150 billion of market cap. There's if blockchain works the way that it should, you don't need those entities anymore. So you're talking about hundreds of billions, if not trillions of dollars of potential disruption, which is why there's so much enthusiasm around fintech. But I tend to look at it myopically across those three verticals, which is lending, payments, and exchanges. One of the biggest things is fintech is really pushed early on as sort of this egalitarian democratization of access to finance, and the reality is it hasn't really delivered into that. And so what I think one of the most important things about blockchain is leveling the playing field. And traditionally, in particular, if you think about underbanked consumers in the U.S., we still aren't delivering better solutions than prepaid debit into that demographic. And the reality is, you should be able to cost effectively deliver a true banking account solution with credit access, with financial literacy embedded in it, in a way that makes sense economically, that is self-sufficient. And so I think blockchain really opens up that opportunity, because the amount of efficiency you can extract, where it was it was unprofitable to try to deliver that solution historically, now you can do it profitably. And so I think what you're going to see is financial technology, and blockchain in particular, be applied to circumstances that provide a more inclusive financial ecosystem, in particular to people that have been denied credit historically, or people that have paid significantly high fees around everything from overdraft protection to the other fees that a traditional bank account carries, or the prepaid debit fees that are embedded in that product. So I think you're just going to get a leveling of the playing field through the technology over the next year. We use AI extensively across multiple dimensions. So we obviously use it from an underwriting standpoint. We use it from a pricing standpoint. There are other aspects of where we use it as well. Yeah, and I think there's been some great innovation done. I think, like Upstart, for example, and the no action letter they got from the CFPB to leverage non-parametric underwriting methodologies to increase the addressable market that they could bring credit solutions to is a great story and a great application of the tech. And so I'm a big proponent of AI in multiple dimensions. Certainly with the level of improved computational power that we have right now, we can do things in AI that we couldn't do 5 years ago, and certainly, couldn't even dream of doing 20 years ago. So, I think it's a big innovative technology. It often gets lumped into blockchain because they're both innovative. They have nothing to do with each other, obviously. And in fact, blockchain is a very slow, cumbersome technology. But I think you're going to see more and more work on AI, but not just on credit and underwriting. I think on pricing, on funnel nurture, and customer acquisition, on a bunch of other dimensions that it hasn't been applied in historically. I think the importance is that right now a lot of fintech is built on old banking infrastructure. And so there's a limit as to how much disruption it can deliver, how much innovation you can do, because you're tied to the underlying rails. And it's a little bit facetious to think that the banks themselves don't have the ability to replicate what the fintechs do. In general, they do. It's just, a lot of the banks have decided that they're better off being in the business of selling the picks and shovels versus, doing the front end in terms of disruption. I think what you're going to see is technology like blockchain massively disrupt the bank infrastructure, but not the bank, right? So the banks will still exist, but instead of running off of Profile and Fiserv and Jack Henry, these back-end systems they've run off of forever, instead of relying on Fedwire and ACH and interchange, they're going to basically move to a universal consolidated ledger, which is blockchain. But they'll still exist, and they'll exist in a much more efficient way that ultimately the early movers in the banking realm that adopt in and lean in heavily on this technology are going to earn significant economic rent, and ultimately everyone will adopt in on the technology to the benefit of the consumer and lower rates and lower pricing. But I don't see fintech disrupting the banks. I see the technology overhauling the bank technology platforms. Because of my point that it's a little facetious as a fintech to think that you have this massive comparative advantage over a bank, because you don't. They have people and funding and resources and all these things that matter. I think the issue is that a bank doesn't have a huge amount of incentive to disrupt itself, right? So if you have a business model that works and there's a new model that would cause a massive dislocation or disruption of the way that you've done things, even though it'll yield to more profitability or more efficiency, it's a pretty hard thing to do on your own. You need a competitive force to really force your hand to do that. And that's where I think, as banks look at technology and they say, well, I can be an early mover and earn rent, and ultimately be well positioned when this is ubiquitous. You're getting more and more of them willing to do that. But it's hard for them to do it to themselves, right? Someone has to come in and say, I have this. And if you don't want to adopt it, someone else is going to adopt it. And when you create that competitive dynamic, it's very different than, if like, I'm sure that Visa's probably figured out how to move money without interchange, but they would never put that out there as a solution because that's their entire business. So I don't think there's any regulatory arbitrage at all for fintech firms. And in fact, that's why, a lot of them have applied for bank charters. So if there was something inherent in the bank charter that didn't allow you to execute your business, the fintechs wouldn't want a bank charter. So take Figure as an example. We have 200 state licenses, and that's a huge amount of burden versus having one national license. And we'd much rather have one national regulator than 200 disparate state regulators, which within the states can be inconsistent. So I don't think I think it's heavily regulated. And I have more regulators than almost any financial institution out there because I've got 200 different licenses. So what needs to happen is some standardization, maybe state reciprocity on state licensing, something, or you're going to see more and more fintechs pursue national charters. My basic view is that blockchain is going to become ubiquitous, and a lot of the things that we have today, like custody banks and exchanges and ACH or interchange, they're going to go away. And blockchain is effectively an ubiquitous universal ledger that doesn't have borders, it doesn't have friction. It allows for the real movement of value between any two counterparties instantaneously. It's massively disruptive, and will bring a level of democratization into finance that we've talked about but never really implemented in the last 2 decades.